Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. All right. CPI today. And this is going to be an interesting one. Last time around when we had the CPI, it was a little bit hot. It was not the end of the world. This time, if the CPI is hot, it'll be the end of the world. For markets, at least. I'm just coming in here. Things are still pretty quiet here in the treasuries. I'll go over to the charts, and then I'll kind of explain the scenarios, right? So here you have the treasuries. I want to note, over the past day and in the overnight, they are up. And it does appear to me that the treasury market is betting on an inline or soft CPI. Surely there are people hedging over concerns that CPI could be hot, but it looks like the traders, it looks like the market is betting on that number being actually a little soft. Here you got the the equity market. Took a little bit of a dive yesterday, but they were able to recover pretty much all of it for the end of the day. Here's oil down towards the bottom end of their range. Gold and silver still looking really great. But they could move big time off of the CPI news. So copper is looking real good. Oh boy, does copper look good. Japanese yen still in the bottom of this range. Then they can't ignite anything to the upside. And the dollar at 103.69 and Bitcoin falling down towards the bottom end of, well, I don't know. It depends on how far back you're looking about for range. Let's say the middle of this range, but below 70,000 and still kind of going sideways. And that one might also do some wild and crazy things here today, depending on what the news is. So let's come in here and today should be the 10th, right? Oh, whoops. I did the wrong thing. There we go. Okay, so flows we've got here. Huge CPI. Okay, also elevated volatility that is likely to contract after event. Okay. We have a, let's see here. Morgan was noting there is a 10-year auction. There is also FOMC notes. I'm also going to note lots of profit taking. So if we do get a news, so the news is likely to be in line or lower, just so you know, because all of the analysts and all of the kind of like more granular data or leading data that we have suggests that it's going to be light. Okay, that's probably why the market is betting on it being a small number. But because of that, people are betting on that. don't be surprised if you see a really strong counter move when those people take profits. Okay. If it's bad, you will probably see some profit taking as well. You'll see the tertiaries just get killed. You'll probably see a pretty strong profit taking. But in the end, probably we end the day down. There's an FOMC member. Oh, yep, we got Bowman. Okay, let's add that. Oh, and we got DOC. Oh, yeah, Morgan just noticed. Point that out too. Wholesale inventories. I don't know if that one's. We'll add it. Wholesale sales. UB looks like NQ on the order book right now, I bet. All right, so I'm not planning on taking any trades in this, but I will make sure that I have my order things up. Okay, that was a weird little shift there before the news come out. Oh, okay, they're moving down. Okay, headline is 0.4 higher than anticipated, but what is core? Core is 0.4. Oh, this is going to kill this market. Okay, so we sell this. Oh, you can't even trade this. 4.45. I was thinking about hitting 445, but I don't know. That's like way too illiquid for me to want to mess with at the moment. Okay, so there's some pretty strong absorption there in the 30 area. That's probably that profit taking that we were looking for. Oh man. The S&P 500 down over 60 points. Wow, 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 wow. I don't know, 445 wouldn't have been terrible. You see the retail traders buying them in the market. Monster move, man. I'm a little bit terrified. I mean, I want to be in on this somewhere. Wow, look at that. Okay, so that's some really weird liquidity there at 26, between 24 and 26. Like, I think that they keep selling it, but that kind of provides a bit of a dangerous spot to get in. Yeah, see? $4.82. 4.9. Or 4.5. Could have made $50 if I had hit it. Wow. And the S&P 500 is careening to 5,200, man. Does they stop there and maybe rest for a little bit, or are they just gonna blast through that? Okay, yeah, I was kind of thinking, oh man, this is just wild. Part of me is a little unhappy that I wasn't able to find a trade in there because of the liquidity, but because of the volatility, I don't know how it really actually would have gone for me. And we've got to be careful the rest of the day. So I think that I should have some opportunities here, but it's going to be really hairy, right? Especially since we still have more stuff coming today. So everybody thinking that the number was going to be soft, and then having both headline and core be spot 4 is pretty much the worst case scenario. Pretty much the worst case scenario. Okay, so there is that pullback to 26 that I was worried about. Right? You could just see it with the limit orders that they were putting down. It was like one robot decided that they were not going to continue putting offers as it moved down past like 26. I'd even say past 30. You can see how it's like there's 2000s all the way through here, but there's only like 1500s through here. And below here, there was only 1000s. So the robots, for some reason, kind of gave us a hint that that was too far. I've never seen that before on a big move like that. Doesn't mean that we won't revisit the lows in the treasuries or anything like that. It's just like a very short-term kind of a thing, kind of suggesting that maybe that wasn't a very good position. That area that we, 445, that sort of spot where it's like the first place that I kind of notice. For some reason, I find them coming back to those a lot as well. So those are some of the things I'm going to be watching. Well, I don't think there is a thing on my board that is up. The RTY hit the hardest, followed by silver down 1.57%. I guess I do have natural gas, wheat, and corn are still up. But like gold and silver took a pretty big hit off of that. Well, I guess if you want to count the dollar, you could say that the dollar is up. These are wild flows. There's about 25,000 net contracts sold in ZN. But this is going to be something where, I think that the net change on the day could be hundreds of thousands. The point, where do we get in? That's the big question though, right? Well, there's a spot that I could probably take a tick. That right there. I don't know if you want to be buying against it though. Wouldn't have gotten filled anyways. And slam down there, man. Well, I tell you what, I had a big distribution or a big contribution to make in my IRA, and I said, no, let's just let it sit in cash until we see what the CPI is going to be. I think I made the right decision on that one. Okay, Nick Timmeros, core CPI printed above forecasters' expectations for the third straight month. The 12-month core inflation rate rose from 3.75 to 3.8 in March. Fed officials tried to project a cool head around warmer inflation at the turn of the year, given well-documented seasonality issues, which help explain why the March reading on prices is taking on greater importance. That was an hour ago from Nick Timmeros. So basically, the market cares a lot more about this CPI report than the other ones. Okay. Shelter up 5.7%, greater than 60% of the yearly increase in core CPI, says Eric Wallerstein. Okay, so that is actually what we expected, which was that we had some leading indicators suggesting that the price of housing was going up. Actually, you know what? This is kind of funny because the zero hedge preview on this number. Let's see here. Where do I come in? They talked about the political implications of it, and they basically said, tomorrow's number will miss printing at or cooler than the 3.7% year-over-year CPI estimate. Not because inflation is actually easing, not by a long shot, as anyone who shops for, well, anything can tell you, but rather because the manipulative Biden BLS has its marching orders as per the logic laid out above, and to avoid a market bloodbath in the months ahead of the election, now is when the BLS creative friction team needs to start, well, coming up with creative friction. In fact, if we were betting people, we would say that the scoreboard would look something like this, and then they showed that it would be in line with expectations. Okay, and then they went into the real reasons why we expect inflation to be down. Okay, well, they were dead wrong about that, and I want to point it out because I hate it when Zero Hedge pulls that kind of shit, where it's like they make these unsubstantiated conspiracy theories, and people might make bets on them. There was a lot of reason to think that it would probably be in line, but it was not. And it sure was a bloodbath. In fact, I remember I was looking at 5,200. We're already at 5,185. So we're already 15 points below that. We are almost to a 100-point down move in ES. I think if we, let's say, because there was this little spike above this, right? So I think that we could say when we touch 5,180 that we've had 100 points. And the treasuries have not really backed back. I think that in this pullback of sorts, if you could call it that, we maybe got 4.47. How much is the curve flatten? That's a good question. So you can come in here and look at my chart where I have the spread, and you can see the spread correlating with both the price and the order flow very heavily. Now, if we go back out here to the ZN, you can see that is a pretty significant push lower. Actually, can I do it on a daily chart? There we go. Wow. Yeah, they are. Let me try and come in here a little bit better. Yeah, it looks to me like those are new lows. That these are new most flattest that we've had. Did you see the little post on Zero Hedge claiming about super? Yes. Oh, I wanted to read that for you guys. It's not even above the front page anymore, is it? It was like pinned last night. I thought that was important. I wanted to read that to you guys. Oh, where is it? I don't even see it. $152 yen level. Okay, I'm hearing some people pointing out that around the 152 level, that the Japanese yen would consider doing currency intervention. I don't know at what point that would actually be, because I'm only looking at the futures. The futures, it's like 150.91, so we're still a ways away from that, but in spot we're probably closer than that. Oh, here it is. We can read that later. We need to pay attention to this right now. See it. They haven't touched 4.5 yet. They're awfully close. Okay, my news squawk is pointing out that they are not expecting text for Bowman. But we are going to be getting comments from them. It's another big absorption there at 19. I'm really wondering, so when I've played on moves like this in the past, I've had the call right and got burned a little bit. So today I was trying to be a little bit more cautious about it, but I really did not need to be. I could have done 4.45 and made like $50 and I would be super happy with it. I don't know if it matters. I think that I'm going to continue to be a little bit on the risk adverse side for a few months. I mean, now that we've had this, you may start to see volatility explode, and so we're probably going to get plenty of opportunities to trade here. Man, those sellers, they're taking advantage of almost any uptick to just sell more. We are now -50. Wow. This is an insane down move, guys. The underlying touched it briefly. I think that they're going to push for it. But once we get to 4.5, you might see things. Let's see if things shift after that. You can see the dollar made a little bit of a change there. So the dollar is going to be extremely influential in there. We've had the largest down candle in the dollar that we've had in a while. So this could be where a pullback comes in. Liquidity looks better. We're getting 2000s at every price now. That's only like a 2 or 3 tick spread. So I think that I would feel more comfortable putting something in there now. I don't know about if I'm getting a price that I would like. If we were to come back, like, let's say, well, there's 26, but I'd say maybe even further than that, maybe 30. And then I would be a little bit more anxious about looking for a short, but... Rubbed to my eyes, and I don't think that. Asher came into my office yesterday and just like... I rub my eyes with a Kleenex, and it's like a fresh Kleenex, and it has to be like the most plain. It can't have any kind of lotion on it or anything like that. Then I'm okay. But if it's like been sitting out for a few hours, then it's bad. I think it's dust mites is what I'm allergic to. But... Rochelle's shares debuted 2x leveraged inverse Bitcoin ETFs. Wow. think that the S&P 500 can recover 5,200? What should we change the title here to? Hot CPI. I want to say something about that this is like a pretty key turning point. Let's just say hot CPI crushes markets. I need to work better on coming up with like really, really eye-catching headlines or something. Pretty key indication that we're after. What is a pretty key indication that we're after? I'm having a fantastic say so far, and the market hasn't even opened. Oh man, you opened a straddle just before the news. Oh my gosh, man. You know what though? Like if the number had been good, I think that volatility would have gotten crushed. So that's good. So I wonder though. So you tell me. Looking at the options and how it went through, do you think that there was a better trade? Think it would have made more sense to just go like to just buy puts or something? Like how much would you have made if you just put that money into puts? Like what did we give up by doing the straddle relative to, you know, the risk that the number was going to be bad? Yeah, it would have been F if Ivy got crushed. It also kind of matters like how much you would have put at risk for it too. Or like how much you had to put at risk. I don't know. I care more about like what would have been the minimum amount that you could have put into that more than like how much you actually did. Because that would be more relevant to other people about, oh, you know, would this have been an opportunity for me to take on risk? You know? Okay, 23 isn't bad. 23 half was kind of like the volume node from all of this. And there has been, I mean, there's 47,000 contracts just there. So I could maybe justify going short here anywhere above 23. I kind of suspect though, and let's zoom this out a little bit, looking at the dollar, you know, the dollar tends to come back a lot more than that. So, and I don't think that they're done. So I'm just gonna try and sit back and relax. Actually, I'm starting to have some problems. I think breakfast is, I don't know. I didn't eat what, oh yeah, you know what it is. Last night they had chicken wings and they screwed the order up, and so we got like spicy wings. And so I was tasked with eating all of the spicy wings. And I think what's happening is now that the spicy is hitting my colon, that it's irritating my colon. Okay, the straddle crossed was 22.50. Oh, that's not bad at all. For like spies or yes. For SPX, yeah. For SPX, that's not terrible. There's IV to risk, but I had confidence that this move was going to outweigh any IV question. It was. It is. So you're not the only person that I saw out there yesterday pointing out the unusual position that the options were in and suggesting that there was a good chance that the market would outperform the volatility that they were pricing in. But that kind of a comment, I think, had to be taken in line with, well, you know, what if it's lower than anticipated too? now that we've actually gotten the number, it kind of seems silly. But one of the things that I keep coming back to in my mind is why are the analysts so wrong lately? Like, I mean, it's played both ways. So I'm not going to say the data has all been good or the data has all been wrong, right? When you go into non-farms, the non-farms number keeps being way better than the economists predict. And then inflation ends up being higher than the economists will. Why? How can they be that wrong so many times in a row? It just blows my mind. Like I know that the analysts are wrong all the time. There's a lot of randomness to this data, but it's like the degree to which they're wrong and the consistency with which they are wrong is not something that I have ever seen. There's something definitely suspicious going on with our data. Political bias, and maybe. Well, so, but that was where I was going back to one of the things that Zero Hedge was saying in their synopsis, because all of the analysts were saying, yeah, it's like, let me draw a picture. Oh, actually, I can just find it. Here's their CPI preview. And one of the things they pointed out was the estimates, right? So the analysts were pretty much all right around 3, with a few actually saying they would be 0.2. And nobody saying they would be 0.4. Okay. And it wasn't, and I think that they had good reasons to think that too, because, you know, we were getting some data points that suggested that it was going to be low. There were 2 things, though, that suggested it was going to be high. One was we've seen inflationary price pressures in PMI data, right? And the other one would be that the kind of leading data that we have for housing has suggested that housing's continuing to go up. Probably, I guarantee you, here's something that you're going to see happen, is Paul Krugman is going to drag out his super core CPI again, right? Because the housing accounts for almost 60% of the increase in inflation. 60%. Don't forget the 10-year auction. Well, don't forget the Bank of Canada. Man. Like, there's the... So coming in here, okay. Bowman was speaking, we're not getting too much from her. Bank of Canada, should we put this... We should put this, like, the times, right? This is 9:45. 9:45 ET. This was 8:30 ET. Okay. Wholesale sells 10 Eastern. And this one is 1 Eastern, right? Let's say 1300 Eastern time. That the FOMC notes would be 1400 Eastern time. Hamas tells negotiators it doesn't have 40 Israeli hostages needed for first round of ceasefire. Well, that confirms that one. I remember seeing a story last week or the week before, speculating that they didn't have many prisoners left. That they died from the conditions that they were in. Probably. Combination, you know, it's going to be a combination of factors. One terrorist was too rough and killed somebody. One terrorist just got pissed off and killed somebody. Somebody else died from an infection. Can you imagine if there's any of those people still alive right now? It is just, it pains me to even think about it. Can you imagine being held prisoner by terrorists since October? Since October, it's been 6 months. We forget. I tell you what. When you think about that sort of a thing, right? Because something that I've noticed happens so quickly is that like the internet seemed to forget what was going on so quickly, you know? Because all of a sudden it was just the focus on Gaza and the plight of people in Gaza and stuff, and I was like, yeah, but there is kind of a terrorist state, like the one that I'm like, what the heck are you guys thinking? Is that there's so many people that are still like, we need to have a 2-state solution and we need to have it now. Okay, you know what? 2-state solution, long term, maybe as a goal, I can see that. Okay, but you do not create a terrorist state in your backyard, right? That's dumb. They're not going to do that, right? Right? If they get to the point where Gaza has been like de-radicalized, and you know, like maybe with the rest of Palestine, okay, like the East Bank, is it? Yeah, like the East Bank stuff. Maybe they could start the process towards like but like with God, no way, man. No way, man. The whole thing is crazy. The whole thing is crazy. Want to know something? There was no Ivy crush on these options, only a slight that happened now since it's been an hour, but I looked at my Ivy charts and it didn't crush. Well, at some point there will be an Ivy crush, but probably not yet. I mean, look, the Treasury is pushing at new lows as we speak. So crazy. I don't know, the trade for that was maybe like $10 though. But look, they have touched 4.5 now. I don't know, man. I think I was just too picky. I'm so again, I've had some moves lately where I come in here and I look at the micros, right? And I'm like, okay, 4.45. And all I can do is say, does that price make sense given the news? Because at that point, it is too difficult for me to judge based on how far the main treasury went what the micro should be. But I said, okay, I could see 4.45 being a decent spot. But then I'm looking at it and it's like I get hit into that and the spread was like 20 ticks. And I'm like, no, thank you. Because I've had that happen and they had to puke on those, right? And then things kind of tightened up a little bit. And then, you know, these guys came in and it just went and went and went and went. So that time it would have worked out, but I shied away from it because I've been screwed on that one. And I kind of said, you know what? I should avoid these really, really big data releases unless it's really clear which way it's going to go. Well, now I have one where it's like, it seems to me that it is really clear which way it's going to go, but I haven't been able to find myself a spot that I was really happy with. So am I just too picky? Now I come back to, now I'm not sure if I actually am following my strategy. I may just be not trading because I'm scared. I don't know. If I come back over here to the treasury, so what would my strategy be? I want to see strong autocorrelated order flow. Well, we did see that all the way up until the low. Then we've had a pullback. Then we came back down. I didn't have anything necessarily to tell me that the pullback would be stuck at 24.5. I guess I did identify the 23.5 as an interesting area. They may not actually make a new low. For all we know, they could bounce here still. Yeah, I guess this is especially when you're seeing these things right here. That's dangerous. I don't want to trade that. Okay, but has the flow been like strongly autocorrelated since that? No. So I guess my strategy does not necessitate that I sell here. Would have been nice if I was in on the move down at some point. You know what was another thing that frustrated me is that on this release, that my data sources did not show me the numbers until it was already well gone. Like a lot of news events, I see the market move at the same time that it pops up on my screen, but that is not what happened this time. iJohn says the same. That may be part to do with just like the amount of anticipation around this particular piece of news and stuff. But. So when you say strong correlated directional order flow and you point to delta, do you also implement liquidity changes / behaviors? So when I'm talking about like strong autocorrelated flows, I am talking primarily about an imbalance between market orders and not the liquidity. The thing is, when I look at the liquidity, what I should typically see is if we tick up, so say we ticked up at 20 here, okay? And they put 500 on there. Okay, well, maybe that 500 will hold, maybe it won't. But I would expect to see at the 19.5 or whatever is that the next tick away and is safe, 2,000 to 3,000 contracts, right? If I'm not seeing that as we move along, then I think something is up. It's very unusual. Like I should see a certain amount of liquidity stacking above and right. Like right now, all of these are 2,500. All of these are 2,500. Now, something that you are seeing in the treasury right now, and you do tend to see these on strong downtrends, is downside targets, right? In the direction of the trend. You don't see those sorts of stacks up here, right? They're not there, right? That is likely because you have guys that are short and they put their limit orders out there and they let them rest. Because, you know, you don't necessarily want the market to know what you're planning on doing, but sometimes if they're really confident that they're going to get filled, I guess they just leave them out there. So that's what those are about. Okay. Well, that was why, for instance, when we were trading here, over here and we got below 26 and the liquidity did not follow it down. So I avoided trading it. And you know what? We had a lot of messiness in that area. It was a really terrible place to get in. Would have had a lot of heat. Okay. So that's where I might look at the resting orders. I think that overall that retail traders pay too much attention to resting orders because their tools are so geared around the resting orders that, you know, it's just like a total attention bias sort of a thing. Like especially with Bookmap. If you're using Bookmap and you're using the Bookmap chart, you're primarily looking at those limit orders and you're making decisions based on those limit orders that, as far as I've seen, are not really very effective at predicting where things are going to go. When I'm thinking about liquidity, I'm a lot more interested in what we would call latent liquidity, which is how many orders were on bid or offer versus how many traded. And then if it ticks back up, how many stack again and how many trade, right? So if I'm in a normal market, I should expect to see about 25,000, if not 4,000 contracts trade at each price. If I'm not seeing that, if we traded from 16 half, 16, 15 half, 15, and there was only like 500 to 500 contracts at each of those steps, that's when I go, oh, okay, right? You won't see that on your bookmap chart. You just don't see that, right? Because it has more to do with what is the limit orders compared to what actually traded, right? It's best to look at all three, right? Price changes, delta, and liquidity. Well, yes, but market orders are probably more important. Okay, so market orders, like a strong imbalance in market orders, is the best indication that we have, just from looking at the data itself of both future orders, and it's the best indication that we have of potential informed traders. Okay, if I'm seeing a persistent imbalance between buyers and sellers, something's up. Right. So the way that I'm thinking about it, the kind of the framework that I would recommend looking at it, because the thing is it's such a complicated thing, right? The order flow, because you've got six forces. You've got the limit orders buy and sell. You got the market orders buy and sell, and you also have the limit orders buy and sell canceling. Right, so those are six forces, and you could be tracking all six of those forces. And then when you bring into that, well, like what you actually have for the limit orders is not actually completely what's shown on there. You kind of have to watch it as it goes tick by tick to judge what the latent liquidity is like. That's a very complicated puzzle, right? And the way that all of those factors can interplay with each other is incredibly complicated and random to some extent. Okay, so we have to simplify the market to some extent. So that doesn't mean that the framework that I'm about to teach you is like the whole market or anything like that. It's just, this is a useful framework to help you simplify things that is going to be effective in the points that really matter. Okay, and that framework is this: there are three types of participant in the markets. There are market makers, there are informed traders, and there are noise traders. So all of these retail traders trading out there based on some pattern that they think that they're seeing, and for the most part, they don't make money. Those are the noise traders. Noise trader Ned. You don't want to be noise trader Ned. He loses money. Now the market maker, he doesn't necessarily know what's going on. He just has a good spot in the queue and has a lot of liquidity to trade. And his objective is to make money off of the spread. That, like if his average win, like you take the amount of money that he made divided by the number of contracts that he traded that day, his average win is going to be something between 1 and 2 ticks most of the time, depending on the spread of the instruments and other things. But, if they're higher than 1 tick, they're doing really, really great. But their goal is to just make the spread, okay? The biggest threat to that market maker is the informed trader, because the informed trader, he's going to sell it. He's going to add you inventory long, right? And then he's going to sell it again. And you're going to get all of this inventory long trading against this informed trader, and he's just going to keep pushing it against you. The biggest threat to the market maker is the informed trader. He doesn't want to trade against the informed trader. So if he has information out there that suggests that there's informed trading, he's not going to hold as much liquidity out there. That's why you might see in some situations where we will just slip through the area on very little volume, right? It will go down, and 16 is not a very good case, because 16 is a price that they like to fool around with a lot. Okay, but let's just say that, again, we broke the lows and we went several ticks down on hardly any volume. Not a lot is traded at 16 yet. Okay, that's the market makers pulling, because they say there's informed trading out there. I don't know what's going on, but I know that I don't want to trade against this and that I don't want to hold inventory long against this huge down move. Right? Okay. So in that kind of framework, what the market maker is going to do is he's going to watch the net contracts. Is there an imbalance between buyers and sellers? And based on that imbalance that he sees in the market orders, he's going to adjust the bids and offers that he's putting out there to account for that. Okay, so that's why the market orders matter more. The market orders are the best sign that we have that there's informed trading, right? If we have such a huge down move in cumulative delta, right? We know something happened. Right? We know that something happened the market thinks is very important and they are now trying to price it. So that's why I care primarily about the market orders. And then my framework is this. Because usually by the time that I see the orders on the DOM, like it's too late. Like it's already, those orders move the market has already moved. How do I know that more orders are coming? Sometimes I can't know. On a day like today, I think that it sells all day, but sometimes you just can't know. And in this situation, I am expecting some profit taking and maybe more destructive pullbacks than usual. So, I don't really like trading these prices down here. I've kind of been sitting on my hands and talking myself out of trade. Actually, this up bar that we've had from 16 to 18 halves is a pretty big one. Relative, that's probably one of the biggest up bars we've seen all session. So that's going to be something that makes me think twice. Okay. But if I know something, they're going to sell it, right? I want to know how many orders are going to come through. And then what I can do is I can look at the current conditions to judge how it's actually going to behave, right? That's when I can come in and I can say, these guys are going to sell into this spot. I know that this spot is probably going to have more liquidity than others. So they're going to trade it into that spot. Maybe there's going to be some pushback, but then he's going to have another leg and he's going to need to sell more, right? And you can end up getting some really accurate predictions about, like how it's going to pivot and so forth based on that information, right? But that's where the market orders are generally the orders that I'm predicting, and the limit orders are kind of like the lay of the land right now. Of course, I can make some predictions about where I might see limit orders come up. Like, if I think that there's going to be more limit orders in an area like 16 because it's a big order, that's a prediction too. But I digress. You get what I'm saying? I'm seeing headlines on Refinitiv that the Fed may end up waiting until September for their... Well, isn't it so funny because I've been saying this all week, haven't I? That there's no way they're going to cut in May, and they're probably not going to do anything until the end of the summer. And then I bet you now, so this is not like a prediction. This is kind of more like Seth's cynicism. I bet you that by the end of the summer, then we will be looking at the situation again, and maybe they push it back again. It seems to me that this Federal Reserve is extremely weary about breaking this market. They are trying extra hard to avoid a recession. They seem to think that a recession would be way worse than having inflation reignite again, which I don't think is true, but and I'm not saying that's necessarily what they believe. I'm saying that's the way that they're behaving. I have a Bollinger Band indicator on delta and volume that will show me when significant two standard deviation volume sizes are coming through, and that will show me when aggressive informed big traders are coming in. Yeah. Okay. So with that sort of a thing, okay. Here's what I would say. If I automated a strategy to say when there is a so there's cumulative delta, but it sounds like you're saying delta, which is how I would do this as well. To say, okay, here's each bar, yada yada yada, and then I have an oscillator that says, these are all cells. This is how much sold, right? Here's how much bought. And then I've got some sort of Bollinger Bands on these, right? And then if I come in here and I have like one of these that really comes out, right? Then that's my signal, right? If I did that, and it doesn't matter if I said, okay, when that happens, I want to buy 2 versus when that happens, I want to trade against it. I would bet you that strategy would not work very well. Because what happens is a big impulsive order like that, like really damages the liquidity and tends to cause the market to just do this around that area and just go sideways. For, again, that can create a liquidity hole that can be a 45-minute time period where it does nothing. Okay. What I look for, that's not how I use it. But what I do is I put R2 on cumulative delta. If I was automating it, I would put R2 on cumulative delta, and I would put correlation between order flow and price on there. And I would say if the correlation is high and if the correlation between price and cumulative delta are very high and the autocorrelation of cumulative delta is high, then I take a trade. I created that strategy, and it was one of the best performing strategies that I ever had on the backtest. The only problem is that I do not trust the backtested data that I get for that, because you have to do it with tick replay, and it's not, there can be slight differences. I don't 100% trust that. But looking at that and kind of making that my strategy for like, okay, I think that there's going to be an imbalance. Do I see that imbalance? Price and cumulative delta are highly correlated. I do see some evidence of autocorrelation in cumulative delta. Not too much, because I do want to get into it early. Then I can take my trade. That's the way that I do it. If the inflation didn't fall more from January until now, I'm not sure if it will over the summer, and without a few more months of constant decline, I don't see cuts, says Andre. Well, yeah, this is a good point, which is that given what we're seeing in the housing data, and given that the majority of something like 60% of the number that we're seeing is because of housing inflation, that means that these inflation numbers are not going to look good for the next few months. We could still get spot 3, but I don't think you're gonna see a spot 2. Up 12.9% since January? No way. Maybe if you look at like the percentage is up 12.9%, that might be. Well, so while we're talking about that, S&P 500 is about to open. Can we read some stories? Okay. New Squawk sums up today's CPI print, and it's got Mo kicking out, I don't know the name of this character, the guy that's always drunk. Mo is 2022, the Fed is kicking inflation out, and then he turns around in 2024 and he's already back in the bar. Yes. Okay. Love it. After increasing month over month for the last 5 months, headline CPI was expected to slow modestly in March, but obviously still rising. However, it did not, rising a hotter than expected spot 4% month over month. energy and services dominated the rise on a year-over-year basis. Core CPI also rose more than expected. Within the core index, goods costs continued to deflate on a year-over-year basis, but services are reaccelerating. Under the hood, the surge was led by energy and shelter costs. Then they got highlights. I'm not going to read through all of these numbers because I kind of felt, I know that when I read those numbers, that my eyes kind of glaze over. It's way better for me to just read those on my own, and get a feel for them. But I will point out the index for shelter rose in March, as did the index for gasoline, and combined these two indexes contributed over half of the monthly increase in the index for all items. Food index increased spot 1% in March, while food at home index was unchanged. Okay, and one step deeper, the so-called core CPI services X-Shelter Index soared spot 7% month over month. Really? Worse still, every sub-component in Supercore rose on a month over month and year over year basis. Oh, okay. So remember earlier I was saying, I bet you that Paul Krugman is going to trot out Supercore. Well, but what are you going to do if Supercore is high as well? So maybe that's not actually going to happen. Finally, we note that consumer prices have not fallen in a single month since Biden's term began, which leaves overall prices up over 19% since Bidenomics was unleashed, and prices have never been more expensive. That is the average of 6.5% per annum. So, about that shrinkflation, did companies only get greedy when Biden took office? Are we going to see a replay of the 70s? Not at all what the Doves and the Biden administration were hoping to see. Absolutely correct. This print today is huge deal. Let's come back to our charts. Okay. And look at that print today. Isn't that funny? Where was it? Over here? No, it was over here. It was over here was where I was like, I got short. And then this happened and I got out. But I think that I should have stayed in it. The swing would be up big. We are in momentum short in the 10-year treasury, okay? And when you go over to ES, well, they've still got a little bit of room here. Okay, actually, oh, you know what? I need to fix this chart. Something that you might want to do, especially on like higher time frame bars, is to come in and say, to do it on price change instead of on the bar close, so that you can see what the indicator is right now on price change. And where's this one on price change? Okay. So now they all extend over. So the S&P 500 came just short of the 50-day moving average and backed off. And the ATR stop would be at 51.62. So those are both areas. I'm not going to say that that's like a trigger that we're momentum short or momentum long, but those are key levels that those kinds of strategies look for, both for momentum and for mean reversion. Okay, so does kind of suggest to me that the S&P 500 might be done for the day, but we haven't opened up yet. So let's see what the open does before we make some sort of like a buy the dip sort of trade. But to the point, when you look at the S&P 500, right? What if the next bar is this, right? Then at that point, this is a pretty major pivot point. And that could be a pivot point that continues. That might set the stage for September. Like it might be... That's too extreme. Might do something like that. Plot twist, we go limit down. That'd be crazy. No, probably not go limit down. But you could see a big impulse of more selling on the open in the S&P 500. We are breaking the trend, and lots of longs are going to get liquidated. Burn NVIDIA. The IV is probably too high to do it now, but the play here is probably NVIDIA puts, right? I had a few $1,000s sitting in cash in my IRA that I hadn't put into the index fund yet, and I was, was like, oh, well, I can put it in there now. And but then I said, no, there's CPI tomorrow. No reason to do it. Like, the risk is not super huge. Might tell me a lot. And now all of a sudden it's like, oh, yes, it did tell me a lot. So maybe now I don't put that in for a while. Okay, so there's 24. Now, look at what I'm seeing in the in the treasury now. Okay, now do I have signs of strongly autocorrelated flow long and strong correlation between price and cumulative delta? I do. And I had a reason to think that I would see this flow too, because my prediction was that there would be some pretty significant profit taking on these moves. So now this line right here, that's not like some sort of, you have some extra probability of looking there. That's just like the best reference point that I have, okay? So I can look at that one as a reference point. I can look at that one as a reference point. I can also look for these, you see these two right here. They often like to come back to those to rebalance. Like the market maker has to come all the way back over to there to rebalance. So, so now I have to say, if I take a trade right here, and I take the trade on there's some continued rebalancing, how much could I make? Well, I might only make 2 ticks. There's a chance for that. So that kind of makes me think the risk reward's not very good. But we could get up to here. If we do get up to here, it's like the low of the day versus here. That's kind of equal risk reward. That's okay. But it's a long on a downtrend day. So I don't like that. So probably the better trade for me is to continue to wait. Wait until, especially after the Canadian central bank and all of that. And then maybe they give me an opportunity and I can try and get a better spot short. Till when are you thinking about putting that in? If we started to see the S&P 500 like really start to get crazy, like the VIX really spiked up, then maybe I would put it in earlier. But otherwise, I think I might wait in a month or two. I don't know. I guess I just kind of have to play it by ear. It doesn't necessarily matter when I put it in now at this point, right? Okay, so I've been sitting here. My guts have been killing me. I can't handle it anymore, so I'm gonna go and take care of that. I'll be back, right? All right, we're back. Could be a difficult few days if you are positive on the stock market. Thursday, Friday calendar drama, says TLA Trader. Well, now we have to contend with FOMC minute notes after lunch today, right? Who knows what that could do to us? Looks like we've kind of reverted back down a little bit, huh? What is your opinion on psychological levels when you see acting as support resistance? Do you just assume it's weekend traders? I don't have any. Well, so it is a proven fact that there tends to be more liquidity at round numbers. So I like to call them round numbers, right? If it ends in a 0 or a 5, the more zeros and 5s that are in it, the more round of a number it is. It is a well-proven fact that there tends to be more liquidity at those levels. And even the robots factor that into their trading. Now, I would not recommend having a strategy that is like, I think that they're going to bounce off of that level, so I'm going to go and put my limit order at 51.90 in the hopes that you know, it reverses from there or something like that. That's probably not going to work too well. Eleni, Vanessa, welcome. But, you know, one of the things that I'm going to be, the way that I always think about it is, again, like, what are the predicted flows that I'm going to get, right? So if I'm expecting to see 50,000 contracts short, okay, then when I come to a level like 5,200 and we're not even close to having traded the amount of volume that I'm expecting to see, then I really don't care about that level, right? But, you know, if we get to some level, we've kind of, you know, messed around with that a little bit, and I've seen all of the selling that I expect to see, or I have some flow that makes me think that there's going to be long flows that come through, then maybe it might be relevant, right? But that's about where I look in at, like, okay, so there's the orders that you predict. You have to combine that with the lay of the land. Like, what is the current situation? And you combine those two things together, and then you can make pretty accurate predictions and tactical decisions about where to trade. What is going on today? We had a CPI was really hot. Well, it was spot 4% when everybody was expecting spot 3. So what's going on here? Well, the dollar keeps going up. Japanese yen just keeps slipping. Oh boy, is the Japanese yen slipping. I'm gonna kind of watching here. So like 449. So I'm gonna dip my toes in the water here a little bit. I'm not gonna place a trade on, but I'm just gonna say, if I took it here right now, well, okay, so it's already a few ticks against me, so I already don't like that. Forecast versus reality. Changes in expectations about future flows or economic conditions are a very strong predictor of order flows. Yes. Yes. Gotta make sure to end the stream on time today because I have a meeting right after this. So, I was show you well, how should we do this? Let's read the scandal video first, and then if we have some time, we can go talk to Reddit. Okay. Okay. This is a long story, just to warn you, but this is something that I think is important for us to be aware of, and be informed on. Okay. A little over a month ago, a scandal erupted among the relatively small group of economists who keep a close eye on the monthly inflation data reported by the Biden Department of Labor, when they learned that there is an even smaller and much more exclusive group of economists called super users who get preferential treatment from the BLS, including wink wink nudge nudge explanations of where the data may diverge from expectations. That was the case for the January CPI when, as Bloomberg first reported, the BLS sent an email to a group of data super users which explained a suggested surge in a measure of rental inflation, which left analysts puzzled was caused by an adjustment to how subcomponents of the index are weighted. Well, not quite, Uzi. Let's read what actually happened, what we actually know. Once it became public knowledge that there was a secret super user group of preferential accounts receiving economic data immediately following the Bloomberg report, a recipient of the email said that the BLS statistics tried to retract it, and they were told to disregard its contents, almost as if they were trying to hide it after the fact. In retrospect, it appears the BLS really did have something to hide, because in a follow-up from both the New York Times and Bloomberg, we now learned that an economist from the Bureau of Labor Statistics was corresponding on data related to the monthly CPI print with major firms like JP Morgan and BlackRock. In what Bloomberg said, quote, raised questions about equitable access to economic information. Extending on the report from February, records suggested by Bloomberg revealed that the unnamed BLS economist answered numerous inquiries about details within the CPI in recent months, mostly related to computations in key categories within shelter, as well as used cars. According to the back and forth between the financial firms and the economist, who has been with the BLS for many years, was first reported by the New York Times. As discussed previously, the government bureaucrat sent several emails to a broader group, which he called my super users, in one of the emails obtained by Bloomberg. The BLS previously lied when it said it doesn't maintain a list of super users. Well, the BLS doesn't maintain a list of super users, but apparently an employee within the BLS does. Gotcha. In mid-February, one user asked if they could be added to the super user email list, to which the BLS economist replied minutes later, yes, I can add you to the list. The move was an attempt by the lowly paid government worker to curry favor with his much better paid peers on the sell and buy side so that he could one day trade the preferential data access for a cushier job in some hedge fund or Wall Street firm. I think that is their opinion, that that's what he was trying to do, but okay. Still is a legitimate concern. As Bloomberg details, while the recipients' names were redacted from the request, email signature details or disclosures from the employers were visible in some of the provided records. And in addition to BlackRock and JP Morgan, other banks, hedge funds, and research firms, including Brevin Howard, Millennium Capital Partners LLP, Citadel, Moore Capital Management, High Frequency Economics, Nomura Securities International, and PNB Paribas, appeared in the exchanges and declined to comment. Sparrow Management and Wolf Research also came up in the emails, but did not provide comment. Pretty wild, right? Now, hold on, because there's some caveats here. Let me keep reading. Understandably, economists, at least those who were not important enough to be on the quote super user list, have been clamoring to find out more about these super users and are after the BLS staffer addressed an email to those people in February suggesting that a change to the weights of the underlying data within a key measure of rental inflation was behind its surge in January's CPI. As we reported at the time, the BLS told recipients to disregard its contents and subsequently tried to clear the confusion with a notice on its website. The agency said that the email was a mistake. But, as noted above, we now know that this was merely the latest lie by a Biden agency, and so this latest revelation is likely to prompt a deeper look at the dissemination of economic information that has implications for how major assets trade as well as Federal Reserve policy. The BLS encourages people to ask questions and makes itself staff available to engage with the public, but they strive to create equal access to information for everyone, said Emily Liddell, Associate Commissioner for Publications and Special Studies at the BLS. Clearly, granting access only to Wall Street giants is not quite the equitable treatment the agency's woke DEI staffers envisioned. Obviously, this has been an embarrassment for the agency, Liddell said. That's Liddel. The public puts a lot of trust in us, to be fair, and our data providers put a lot of trust in us for the data to be secure. It is our goal to repair that trust. And while the BLS economist often pointed users to relevant links on the agency's website, at least one case, he shared information that was not publicly available at the time related to the calculation for the used cars index within the CPI. Liddell said it is still under review whether the employee shared other non-public information and that the issues appear to be isolated to this one staffer. He is not answering incoming user questions at this time. This is on Zero Hedge. So let me paste the link in here. While it remains unclear who the economist is, the New York Times reported that emails obtained through a Freedom of Information Act request show that the agency, or at least the economist who sent the original email, a long-time but relatively low-ranking employee, was in regular communication with data users in the finance industry, apparently including analysts at major hedge funds, and they suggest that there was a list of super users, contrary to the agency's denials. At the time, the Bureau of Labor Statistics said the email had been an isolated mistake and denied that it maintained a list of users who received special access to information. While there is no evidence yet that the employee provided early access to coming statistical releases or directly shared other data that wasn't available to the public, in several instances, the employee did engage in extended one-on-one email exchanges with data users about how the inflation figures are put together. Such details, though highly technical, can be of significant interest to forecasters who compete to predict inflation figures to hundredths of a percentage point. Those estimates, in turn, are used by investors making bets on the huge batches of securities that are tied to inflation or interest rates. Analysts regularly interact with government economists to make sure that they understand the data, but when such access can move markets, the process for that access needs to be transparent, said Jeff Hauser, executive director of the Revolving Door Project in Washington. This stuff is so valuable, and then someone just emails it out. Yes. In at least one case, emails to super users appear to have shared methodological... See, they're kind of repeating themselves, but I'm going to keep reading, okay? Appear to have shared methodological details that were not yet public. On January 31st, the employee sent an email to his super users describing coming changes to the way the agency calculates used car prices. At the time, a crucial issue for inflation watchers. The email included a 3-page document providing detailed answers to questions about the change and a spreadsheet showing how they would affect calculations. See, it's interesting. It's like, this is all information that like they should have, and I think that the analysts at the bank should be able to email people, but that stuff should be like posted on a public bulletin, you know, like. So I totally see what happened. They didn't really have very good rules or controls around this. The employee thought that what he was doing was okay. I'd still say it's a pretty big scandal, right? Thank you for your very difficult, challenging, and thoughtful questions, the email said. It is your questions that help us flesh out all of the potential problems. The Bureau of Labor Statistics announced the change in a news release in early January, but did not publish details about it on its website until mid-February, 2 weeks after the email from the employee. It isn't clear when the employee began providing information to super users or whether he was the only economist in the agency to do so. Several of his emails were also sent to an internal Bureau of Labor Statistics email alias, suggesting that he did not believe his actions to be inappropriate or he was simply an idiot. The super users issue came to light in February when the employee emailed a group saying that he has identified a technical change that explained an unexpected divergence between rental and home ownership costs in a recent release. All of you searching for the source of the divergence have found it, he wrote. About an hour and a half later, that email went out. A follow-up told recipients to disregard it. In a subsequent online presentation, Bureau of Labor Statistics economists presented evidence that the change identified in the employee's email was not, in fact, the source of the divergence. Okay, so supposedly, and I mean, that's the thing. Supposedly, they're not giving out data releases early, but I have seen enough moves ahead of news to make me highly suspicious. In fact, even today, because even today there was some big sells just before the number came out. Are those people that are able to predict the number, or are they people that have inside information that the rest of us don't have and that they probably shouldn't have? And you can see how there is not enough control around these things and who has access to that information and so forth. Or, in my opinion, for me to really have confidence that it's not happening. And yes, could people also be affecting the methodology that is used to help out a specific politician? That could also be a thing. We don't have evidence of that, but is it something we should be concerned about? Yes, and I do think that we should hold these agencies' feet to the fire about this issue. But there's also something else here to take away from this. Because my takeaway is that if I had read that report and had a question about how a particular thing was made, like I went to the website, I read the methodology, there was like the detail about the methodology that wasn't entirely clear, it appears that I could send an email to people at the agency, and I'm not sure where I would get that information or who those people are, but I have found in the world of finance that if you have a question, you just send the email, and these people are all very happy to oblige. You send me a message on Discord, as long as you have like a direct question in the first message, I'll respond. Sometimes people just say hi, and I'm like, okay, spam. Oh, just ask the question. Get to the point. But, well, no one will ever have evidence. We do have evidence of one thing. I guess the thing is that the one thing that happened, I think, was not necessarily like, so it is a scandal, but it's a relatively minor one, right? Like, nobody's going to go to jail for it. I bet you that that employee keeps his job. But it was enough for them to go, oh, that wasn't supposed to happen. We're going to have to fix some things. Maybe they'll change a few policies, etc., etc. Is there any validity to the time series support and resistance strategy? I have never seen any empirical evidence that supports any kind of intraday technical strategy that you can trade off of a chart. For instance, identifying support and resistance zones and trading off of that. I think it's quite likely that you would find people out there that would make a decent amount of money trading support and resistance in some situations, because that asset is correlated and it stays within a range relative to the correlated asset. And so what they're seeing as support and resistance are actually just the limits of that co-integrated asset. But then when those correlations shift and volatility increases, those people get destroyed. But if I'm going to trade something, so I can give you here, though, there's one intraday strategy I've kind of read about that you could maybe try doing. And that is that the first 30 minutes of the stock market open is an effective predictor of what the last 30 minutes will be. So if we buy for the first 30 minutes, then you can go into the last 30 minutes and buy and over and make a small amount. That's like the best I've ever seen. Okay. That's not like a super great strategy. I don't know if it'd really be worth it for a retail trader to try and pull that off, but that's the limit that we found. The issue is that you have some pattern. There's support and resistance. Yada yada. Okay, cool. Maybe it is a thing. Maybe there is an overall tendency for the market to stay within those support and resistance lines if you could find some way to quantitatively define where those support and resistance is, right? But you're going to have a piece of news that's going to come along. It's going to destroy your support and resistance. The flows that you get on a day time frame are so big that trying to do anything with technical analysis is like trying to look at the tiny little ripples on the surface of the water to try and predict tsunamis. It's not going to work. Not going to be very effective, right? If you want to predict tsunamis, you would probably be better off looking at earthquake data, right? Support and resistance moves with trends. Now, this is the big thing is that, like, you know, everybody says, well, trends work. Okay, but not on a day trading basis. Not really. You just try and trade the trend with it. If you can find me a discretionary strategy, or not a discretionary strategy. Let me start over. If you can show me a mechanical strategy written in NinjaTrader with backtests, and it has been tested on more than 5 years of data, and it has a Sharpe ratio over 0.5, I give you a cookie. Who's taking the hero trade? You think it's time? It does look to me that the sort of profit taking that I was concerned about has come through and is over with. And then that flow subsided. And so you had kind of a bit of a post meta order impact mean reversion period where they fell back into the depths. So I think that now that flow that I was a little bit concerned about has come through, that I could be a little bit more aggressive, or let's say I don't have to be quite so cautious about where I take a short, but I do still want a good price. I don't know if I'm getting a good price at 18.5. It is a little bit late. I don't really like, you know, my first trade being in the last hour of my trading. Where was we were talking earlier? We were at like what, 4.48, and I think that did give us a lot of heat, but it would have in the end gone positive. So that's enough for, oh, sorry, I'm on the wrong screen. So I think that test case would be enough for me to say, I think I'm generally okay with how in line I am with the market. So it would be okay for me to take some risks. I mean, if anyone has a strategy, he keeps it a secret that will never be seen, because when it gets to the public, it does not work then, yes. Well, a strategy becoming public will affect the profitability of the strategy, yes. But again, the big thing I'm trying to get across here is that the time frame matters substantially to this sort of a thing. Technical analysis preachers will tell you that it doesn't change on the time frame, that it's all fractal, and the patterns that you see on a daily chart you will also see on an intraday chart, on a 5-minute chart, and a 1-minute chart, and a 1-second chart, and a 1-month chart, and a 1-year chart. It's total bullshit. The time frame matters substantially, and there are some well-proven strategies like momentum that hedge funds are using, and those are performed on daily charts, and they don't really work on intraday charts. And most of what retail traders know was based on what kind of little morsels of information they got from these people doing momentum strategies, and then they turned around and misapplied it to day trading. The reality is, this, and this is one of those things where it's like, can I prove this statement explicitly? No. I can list a bunch of things about this that can show you how I've come to this conclusion, okay? But the conclusion that I have come to is that if you are trading on a day trading basis, that technicals do not matter as much to you and are not as useful to you, and you should spend more of your time studying the market, the news that's going on, the current situation, finding things that will predict individual flows rather than trying to read charts. Read more analyst reports and spend less time looking at charts. Yeah, the evidence just heavily supports the I can't see what your word is there. It's covered up. The evidence heavily supports the site. Well, let's say the evidence heavily supports the theory that technical analysis doesn't work. Are you going to get in on that down move? Really, and we should assume that everything doesn't work, right? And the onus should really be on the person that thinks that it works to prove that it does. But I don't trade stupid stuff like CPI days, because I'm really tempted to do something here, man. I really feel like I'm way too late, but I just... It just looks so juicy, like that they're just gonna bust 16 and it's just gonna be badoosh, 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 That is a good downtick at 16.5. If I had taken 4.5, I would be up a tick or two. That would have been a good as she goes. That doesn't mean that the trade will work out ultimately, but it would have been a good as she goes entry. So this was exactly the thing that I was going to talk about that I saw on Reddit. No, I was going to do it with my live account. You see the number right there? It's armed. I've been sitting there like I could click on it. No, I didn't. Oh, on ZN, yeah. Oh, like right there at 16. That's probably good for a tick at least, right? I missed it. I was trying to click it as she goes, and I was too late. And I got 15, 14 in line, right? That's how fast you got to be. Are they going to fill me at 16? If they just decide to bust through and there's a stop run, they're not going to fill that. And if they do fill that, there's a good chance that they plow through it and come back to 17. What strategy are you using? I am so I have a PDF on my website. If you go to we'll just say that I use price action. That's my strategy. No. What I really do is I try and put as many numbers on the screen as possible at a time, and then you just look at it and you'll kind of see it as like a group of numbers. It'll just really catch your eye. You really want to do it, and then you take the trade there. That's my strategy. No, if you go to speculatorseth.com/strategy.html, you can sign up for the mailing list, and it will email you a PDF that goes into a description of how I develop my strategy. Basically, the information that you would need to develop your own strategy that is similar. Did that not go exactly how I thought it may? I was worried that it would, right? As I was like, I might be able to get the one tick, but I'm concerned that they're going to get shoved back to 17, and sure enough, big order comes in and hits them. Okay, but this is where we can do degenerate stuff, right? Like, let's say that our stop is at 18.5. That'll give us a pretty good chance of still getting our target, right? Yeah, it's got to be like somebody's watching the stream and they're like, okay, Seth got in, let's come and buy a bunch of it a little bit. Like, let's take a little bit of our profits to scare him out. Am I sensing some English accent, a cap, and hype glasses when you said you put a ton of numbers on the screen? Yeah, wait, have you seen, what is that show called? Spectacular Steve? No, I'm not sure. Whatever you're thinking about, I'm not sure. I don't think that we're thinking about the same thing. No, I'm thinking about Severance. That's what they do in Severance is they look at this date, they just look at these numbers on the screen, and then like their subconscious knows that there's something suspicious about the numbers, and they don't like it, and so they like put a fence around the numbers to contain it. I tell you what, Severance is an interesting show. I thought it was a really well done show, and it does raise. I don't have to agree with like the message of a show completely. I think that the show makes good points about how much of our lives do we give to corporations through our work. It makes a really, really good case. It's a good show. If you have like an Apple TV or whatever, or do you have to have the subscription? I don't know. I don't think you do. But go and watch that on Apple TV. It was a good show. And that's what they do is they just have a screen with as many numbers as possible, and then they will get like a creepy feeling about a set of numbers, and they put a little gate around it. Okay, are you trading the UB? I know the UB and ZB are both 30-year bonds, and the difference is the maturity date. But what else? That's primarily it. Yeah, the difference is the basket of deliverable securities that you can deliver with the instrument, and that gives them a different maturity. The 30-year is really more like a 20-year bond, whereas the 30-year, the Ultra, is really a true 30-year. And then, of course, the liquidity is different in the two of them because of that. So, I'm kind of like being funny and messing around. Maybe I should just like puke this. Because what happened here, I want to point this out just because it's a good teaching. Like, I'm messing around and I'm realizing, like, actually I'm missing a good teaching opportunity here. I don't know. Is that my primary thing should be teaching? I don't know. I tend to think my primary thing is to take trades and make money, and you're all just along for the ride, but I am teaching here, so whatever. When the trend is down, a large order going the other way will have more impact because you got that wake behind you. And that's what happened here. There was a big order at 16 to 17, and that hurt my position. Under normal circumstances, I would just stop out of that. I'm kind of a little bit like, I don't know if they're really going to like fully bounce here. They might settle back down, so I'm willing to gamble with it. But this is kind of a gamble degenerate thing, right? I don't know. If I try to get out with a limit order, will it let me? Let's just try it at 17.5. So if it won't let me, then I definitely don't want to be in this trade, right? Yeah, that's not good. Well, I'm gonna stop out right there. Market Tesla had a webinar explaining this with floors and ceilings. Like, after you break the floor, there is no ceiling, and it's easy to climb back. Well, man, I don't know. I think of it as like a wake, right? Like, if you're in a boat and you're going through the water, and then you suddenly stop, the boat will usually settle back a little bit because it falls into the wake that was behind it. That's essentially what's happening. That was a good sneeze. That felt good. I'm kind of looking at this now, like nothing too interesting about this spot. There has been another impulse of volume long. In fact, we're going to be getting soon to, there is more that the cumulative delta is almost higher than before the news.
Block sell.
Oh, big sell. Interesting. At what? 31, 17.5. It was 31.74 lots. So I think one thing is that if somebody like got in here at 16 and then they got, that may have been their exit potentially. I think though, especially given the time, that order going through there makes me not want to take a trade now. I think that I will put the safety back on. Switch this down back to a sim account so that if I misclick, don't enter in a live order. What was I going to talk about? Okay, I was going to talk about, okay, r/day trading. Thread says popular mechanical trading strategies perform poorly when automated. Does anyone have an explanation why I wrote automated script /bots for some popular strategies like pin bar, Bollinger, engulfing, moving average crossover, etc.? These strategies are touted in trading circles as having positive edge. The backtest results on them are so poor, I started to think trading their opposites could yield better results. I'm wondering if anyone have possible explanations for that or have tried trading them in automated bots. Thanks. We should try those on daily bars. Could be interesting. So what I said, I made a comment. I don't know if you really need to go into it because it's just going to be what I've said all the time. It's like, well, there's You're day trading. Mechanical strategies don't work very good on intraday. If you're not like doing a market making style of things where you're trading very, very short term things or like correlations, right? Really hard to make money day trading. That's just the way that it is. And if you are going to make money day trading, I think that it's going to come from being informed. Okay, well, what do other people say? The top comment says this: every system has discretion built in. Someone has to decide which markets, which strategy, which signals to use, and so on. A truly mechanical, non-discretionary system isn't something that exists. Talented and experienced traders can make just about any system work because they will inevitably make some discretionary choices on the margin that will mean the difference between winning and losing in the aggregate. And they know when to ease off a choppy day or to step on the gas. Things get really ugly, they just shut their platform down. An automated system without an extreme level of sophistication beyond the reach of most small-time traders isn't going to replicate the judgment of a good trader, therefore it will necessarily underperform. Okay, but this is this issue that I always have with this is like, okay, so how do you know that the edge is not entirely their discretion? And what is it that they're actually utilizing as inputs to their quote-unquote discretion? Because if everything that they're using is just things that you can see on a chart, then that should be backtestable. You might not be sophisticated enough to make it. I might not have enough time to make it, but it can be done. But if it's based on other things, information outside of the markets, then it's a completely different thing. And how do you know that it's not the information they have outside of the markets that they don't realize? And this is the issue with discretion. Is discretion can't prove anything about the market to us. Somebody being successful with discretion doesn't really prove anything to us about like what is an effective strategy. It doesn't really help you, right? Like if it's a technical analysis strategy and I can prove to you that the strategy works and over this time period and show you the results, now you say, okay, here's a behavior in the markets that we know is really truly a thing. I might not be able to trade on that specific thing, but I might be able to see how that could affect markets in other ways or affect the market in particular situations when I know what's going on. And then it can help you. But if somebody made money and it's discretionary, you don't know. You don't know if they were lucky, if there's actually something to it. If there is actually something to it, what actually was the thing that was bringing them the success? They probably don't even know themselves. A smart guru, somebody that's trying to deceive you, just wants your money, they will be careful to not ever give you anything that's quote unquote backtestable. Because as soon as you give them something that's backtestable, people will backtest it and show that it doesn't work. Because it's the time frame. Like the real issue here in this situation is the time frame. There's too much noise on a day basis for any kind of an edge that would be based entirely technical to really shine through. These other flows that are for all intents and purposes random are too big, relatively speaking. So here's somebody that actually has a real answer. I did the same. They don't work, period. That is why fake trading gurus are teaching you how to use them instead of making money by trading themselves. Nobody will teach you or sell you something with a true trading edge. Real trading firms are going to extreme lengths to protect their trading secrets, even to the point of hiding their own existence. Yet on the other side, you have a YouTube guru selling you a great trading strategy for $59.99. Well, and see, so Speculator Seth, he has a strategy that you can get for just signing up for a mailing list that he never uses and has never sent an email from. And that strategy probably won't make millions of dollars. That strategy just kind of gets you on par. That strategy gets you to the point of understanding what you're actually up against, how the market actually works. Some things that will kind of help you maybe be break even. This is going to be up to you to try and find the edge. And the suggestion is that the edge is going to be in pieces of information that you're able to find that are not insider information but aren't properly factored in the market. So maybe speculator Seth should charge $60 for that strategy. I'm sure lots of people would buy it. But I think speculator Seth would rather. I feel so weird talking to about myself in the third person. I would rather make indicators that I know work, do what they say, and we know have some use. If I'm going to make some extra money on the side, do it through indicators rather than selling a strategy, you know? Or write a book and get it published instead of, you know, having a course. To me, like, selling a course is like makes no sense unless I'm like going to get up in front of the class and teach it every day. Oh man, I was watching this video the other day. What was it? It was somebody from Charm. So there's this company that makes open source Go libraries that help you make prettier looking, more cool command line utilities. And so I guess YouTube has been showing me that stuff because I've been doing a lot more with the command line lately. And they have this creator that's a really, really good looking girl. And she was talking about doing that. And now I lost my train of thought. You see that? I was like, oh, they're really good looking. And then like all of my thoughts just went out here and I completely forgot what I was talking. Oh yeah. So she was saying that she went to one of these schools, like not a university, but some kind of technical college of some sort. And it was like online, or no, maybe it wasn't online, but like she said that like the teachers wouldn't even come in. Like the teachers wouldn't even come in. They would just write on the board, just, you know, watch this thing and do this exercise. Right. So it was all self-guided. And I'm like, why am I paying so much money for this when I could go and find that sort of a thing online for free? Right. So that's what she did. She quit and she went and learned this stuff herself. I thought that was really cool. But it was like made me so furious that there are places out there selling like quote unquote education and then not even really giving people the education that they paid for. It's so awful. I would love to do that. I don't have the time. I don't have the time to do that, you know? Come in and teach a course every day about day trading, right? So I make videos and you can watch the videos instead. And then if you have questions, you can come and ask me during the stream. That's good enough. Isn't that maybe even in some respects better than if I had a course? I kind of feel like it does. Or it is. Well, so far, my read of that big order is correct, that we've kind of started to chop around in this area and that it was not an area that I wanted to be involved in. So. Lips are super chapped this morning for no apparent reason. Bitcoin took a pretty... So, some of these assets are reverting back up now. The treasuries are still down in the doldrums. One of the things I like about the treasuries is they'll make a move and then they'll just stay down. Like the number of times that it just completely retraces the move. It does happen, and I'm always furious when it happens, but it's a lot less often in the treasuries than other things. But look at Bitcoin. Look at Bitcoin completely retrace that. Gold and silver completely retraced that. Oil hasn't been that affected. S&P 500, they're just getting a good retracement. It seems like they've reached the extent of what they can do with current volatility. Didn't really go much further on the open. I bet you that they
Block
make
sell.
a bigger attempt to move up higher later in the day. We'll see if they succeed in retracing a ton of this or if they get smacked back down again. So I continue to see big buy orders in the treasuries. I would prefer to sell it. So, but I think that in order for me to sell it, I would need to see a shift in that, right? I would need to see like big sell orders coming in and yada yada. Okay, let's see. Let's pop around and see if there's any more stuff on Twitter and so forth. Oh, see, Jimmy Oreo, he was talking about the key inflation data was leaked to write that story.
Block buy.
Jimmy Oreo's take is, oh, big companies become like partners with government, and that's a problem. Anyway. Brannigan Barrett, U.S. 2-year yields up 20 basis points, gold up $5. This sort of negative correlation tells us one thing. The market is telling the Fed they are making a policy error if they choose to cut rates this year. The market is now doing the de facto tightening for the Fed, yes. About darn time, too, honestly. Any trades today? No. You know, I feel like I really should have, Mr. Pushup. I don't know. I kind of have mixed feelings about really big events. I've lost a lot on really big events. I tend to do better on like a medium quiet day. It's not like a super quiet tight day. There is like some sort of news moving us, but it's still relatively gentle movement. Those are the best trades for me. Those are where I have a really high hit rate. Whereas when it's like thrashing around like this is right now, I kind of get killed. And I think part of that is because I will try taking trades like right after the news when it's really, really super volatile. So today, I avoided that. Now, there was a couple of points where I could have sold the treasuries, and I didn't really take them. So I'm still a little torn as to whether or not I was just too picky. But right now, I want to take a short, and the flows are not cooperating with that. So I think I'm hands off, and I've only got about like 15 more minutes, so probably I won't take a trade today. Canadian futures trading? Never heard of him. Are you talking about Krebs or whatever his name is? There was somebody that they approached me about doing an interview, and I looked at their website and I did not like the promotional materials that they had on their website. I did not think that they were in line with FTC standards. They had testimonials about making money that were not going to be representative of how most people perform, and so I said no. And then they went and they did a bunch of interviews with a bunch of other people, and I was like, well, probably would have helped the channel, but I'm okay. I don't want anything. And yes, they were selling a course. like the thing is that I get it. Like, if you have a YouTube channel, that is a very valuable asset. And even if you're making money, you kind of want to do the best with it. Okay. But if you don't have the money, then, and there's some opportunities for you to really make a living off of that, you go for it. And of course, you're not going to do something dishonest. I would hope that people don't do something dishonest. Okay. But, you know, you're going to make courses and you're going to have to convince people to get them. And you're going to put out the best course that you can. But, you know, the best course that it can, is it worth it or is it not? I don't know. It's kind of an iffy thing, right? Whereas with me, it's like, well, it's not very likely that I'm ever going to make a stronger living than what I'm doing right now with my day job. So why even bother with that stuff? You know? That mean that in a different world where I wasn't a site reliability engineer, that maybe I would make a course and I would sell all of that stuff? Probably not, but I don't know. Bank of Canada's Macklem says that June rate cut is possible. Okay, you say so. You know what I think the real issue is for me, what it really comes down for me is, do they have empirical evidence? Like, if you have something where empirical evidence is provided, I can see like back tests of it, or you know, whatever the deal is, like this book, Trades, Quotes, and Prices, Financial Markets Under the Microscope. All it is empirical evidence. The end of every chapter, well, you know, there's all of these formulas and stuff. There's chart, you know, they show you the actual data, like how it performs on real world data to show that it actually is a thing. And then at the end of every chapter, they have, you know, all of the studies and that you can go and read where all of this information came from. That one's a short one. Some of them, it's like 3 pages long. Okay. It's a book. I paid for the book. How much would I pay for that book? Oh, man. I don't know if I ever make money from it, but I'd be willing to pay thousands of dollars for that book. I love that book. It's just, it answered so many questions. And part of the reason it answered so many questions was because it could actually prove it. There was actual real empirical evidence backing up what they were saying. It wasn't just some guy, I have this experience, this is what I think, yada yada. Or like some sort of chain of logic to how they came to their conclusions. Like, no, it was the actual real empirical data. And the reason that I get, you know, kind of bothered by a lot of the education that I see out there is that none of it is based on empirical data. You're charging people for stuff that's not based on empirical information. And it irks me. Let's see here. RGE trying to do a bit of coding on Helix Editor cannot set up the Python server, so it predicts, corrects, etc. Any tips? Oh yeah. Okay, so this is a great question, RGE. I love that you asked me that question. Were you watching yesterday and you started using Helix because of me? Okay, so you can do this. You can do Helix -- help. And when you do Helix help, it will show you the status of all of these language servers. So you can see that for me, most of them are not working. In fact, on this computer, probably none of them are working because I haven't set that up on any of them. On my work computer, I've set them up. So what happens is you have to point it. So what was the, let's see here. Python, you say, right? Okay, so here on Helix, somebody has a comment that tells you how to install them. So they're saying that it uses Pyrite. So if you go and you pip install these things, oh, there's Pyrite, Rough, and Black. Okay. So they have to be in the right space. So the way that it generally works is that the LSP has to be available somewhere in your path. So for me on my Windows machine, I will just install the language server somewhere and then add that language server to my path, and then Helix generally can see it after that. I might have to like restart my command line so that it picks up the new environment variables, but like once I have it in my environment, it picks it up, it can see it. Sometimes you have to have the folder structure correct and stuff, like it's looking for them in a particular location and stuff like that. Okay, but you can also do things with, you can change your Helix config. So if you come in here, where did I go? If I'm in Helix, I do edit or config dash open. Then this is my config file. So here I've changed a couple of the defaults. I changed the default theme. I turn on relative line numbers. I changed the cursor shape based on which mode I'm in. Display LSP messages. These ones I turn off, but if I turn these on, I can kind of see where the spaces and the returns are a little bit better. Anyways, then you add that section in there, right? For the language, Python, language servers. And I think you can even do things like where they are from and command line arguments that get passed into them and stuff like that. So that's probably about as much detail as I can give you without more information on your machine, you know. Have you tried Gary's? So not his new one. I'm very familiar with his old one though. And I have to say, like, he provides a lot of content. So is it worth it? Kind of depends on you. I could be wrong, but I think I've only come across one person so far that's done the new full course, but I know a number of people that before that, you know, did the thing, and they do okay with it. I think it's still a side job for most of them, but they've been effective in what they want to do. RGE says thanks ... So I don't know if that actually answered the question, did it? But hopefully I showed you a couple of things that you didn't already know, yeah? It's part of the thing. It's turbo nerd stuff, right? Part of the turbo nerd stuff is that figuring everything out is super, super hard. You know? We have to have a meeting in 10 minutes. We got 5 minutes left here. And I should be logging off. Well, I'm liking this 20 better. I think that 20, I would consider 20 the middle, so I would still, if I'm going to be short, I'd have to be above that. I think the chances of like me getting filled up here aren't very good. Especially before the stream ends. But over the course of the day, we could certainly go lower. But remember, Today. We've got still a bunch of things going on. We still got a 10-year auction and FOMC meeting notes today. How much money? Well, I never really sat down and like really put all of my effort into trading his strategy. It was kind of like I wanted to know what they were talking about, demystify it a little bit. I would agree that, so I think one of the things with Gary's original course, because with his original course, people were like, well, it's like $5,000 and all I got was this little PDF and it's not even that long. I would say that especially if you were like just beginning, you would read his book and you would not realize the significance of some of the things that he was saying. Right. That's why here, well, he has his way of like promoting it and things like that. Here, I try and demystify it for you a little bit so that you can have a better idea of if that's really a style of trading that you want to go towards, right? He's relying very heavily on correlations. Basically, he's saying the value of this asset is based on the relative value of all of these correlated assets. And I can watch all of these correlated assets and know what's going on and sometimes see where there are small inefficiencies where I might be able to get a fill at a price that I shouldn't. Right? This is just like right here where I'm like, I could put it, if I put a limit order out there and I get filled at 20.5, as long as that's not on like really aggressive order flow, pretty good chance that I should be able to get it back out at 20. Right? That's the sort of thing that you're doing. But he has a lot of little tips and pieces of information about how that all works, that he picked up as an institutional trader. Right? That's basically what he's doing. So correlations is absolutely something that I implement in my own strategies, right? But I've never done it from the point of like, let's take a year and we're just gonna only focus on scalping for ticks and this really inefficient instrument that we found and all of that. So I'm gonna say that I haven't really tried using his strategy per se, but I am incorporating some of that stuff into what we're talking about here. And he does vice versa, because he tells you, like, you need to pay attention to the news. Like, you need to know what's going on, right? So. I know, like one of the things for me with Gary's thing is, you know, if you're considering buying Gary's full course, I would just go for it. Because if you're considering buying his course, that probably means that you already have a ton of, you know, discretionary income anyways. So if you have that much money to spend anyways, what's the holdup? But if that amount of money is difficult for you to get, then probably you shouldn't. But you see, it has way more to do with you than it does the course. I will say, one of the things that is interesting, just seeing if it's truly worth it. Yeah, they're talking about Gary Norden. We did an interview with him once. Oh, I loved that too. I loved that thing. Talking with him. You know, so it's the whole thing that you know, because I think what people want to hear is, oh, what do you think about Gary Norden? Oh, it's absolutely great. You should totally go and buy his $5,000 course. And, you know, I've tried it and I can totally fully recommend it. Right. And instead you kind of get all of these qualifiers about, well, if it's in this situation and that sort of thing. Right. The reason that is you have to understand that what they're doing is very difficult. It's like the most difficult way of trading. It's a way of trading that's dying out because of the competitions from the robots. A large part of the reason for providing the course is so that those ideas don't die out. You gotta understand that if you're gonna go down that route. Okay. It's just like this book again, trades quotes and prices, I might never make $1 off of it. Well, I think that I've done pretty well since it definitely changed my trading. The last year has been pretty good, except for that January. Been doing pretty good since then. But I digress. Even if I never made any money from it, the knowledge, I value that knowledge so much that it was worth it. So Gary teaches you about market making, how to do market making with a discretionary approach instead of with robots. How valuable is that information to you, even if you never make any money from it? That's the question you have to answer. So the other thing I was going to say is that with Gary, so does he provide empirical information in his course? I'm going to say no, but the things that he is talking about are things that you can pretty clearly see just from the explanation of it, how it is beneficial to you, right? So there's one thing where it's like, okay, I have some idea about the market, and based on my idea about the market, this is how I think the market should trade, and this is the strategy to take advantage of it, right? That is essentially how price action, smart money concepts stuff works. Is they have all of these underlying assumptions that they don't say, but the problem is that like all of those underlying assumptions are false. Okay, but what Gary does is he says like, look, here is the actual like rules of a limit order book. Okay, market order matches up with the limit order, all of these sorts of things, right? And then here are some things that if you're going to be doing the market making, that you will help you in doing that, right? And so it's a much more direct, verifiable logic, right? It's like things about the market, about the way that the market works that are very easy to verify, that you can say, yes, that is the way that a limit order book works, right? And then very direct logic from that of, the sorts of things that he talked about are kind of more like, like catching the edge, okay? If there's not a whole lot bid or offered, you can hit into that bid or offer, and if it clears and ticks up, then you can get out at break even at the very least, and that gives you a better chance of getting your next tick, right? That's something that we know works just based on logic, and of course you should be able to back it up with empirical evidence, although as a retail person you might have difficulty doing that, right? So I do kind of think that sets Gary apart from the other educational materials that I've seen out there. I guess the issue is that anybody that really has empirical information that's not already been published in some academic journal somewhere probably doesn't want that information out there, and so they're never going to sell it to you, right? Is there anything here in discussion that we should add in here? Talked about BLS giving privilege to super users. I feel like I've been getting a lot more questions about Gary's course lately. I wonder what's with that. Should fit. Yeah, it does not fit everybody. Anyways, I've gone too long. I will see you guys tomorrow. Stay excellent.